Investors are worried about a slowdown around the world because central bankers are taking a hard line against inflation and raising interest rates to cool down the economy. Will the stock find its stability back? Or will the stock continue to decline? Stay tuned with us as we shed light on the topic. Let's get started. Stocks fell on Thursday, adding to a big drop that has been caused by investors' constant worries about the economy and bringing Wall Street to its lowest point since late 2020. The reasons for Thursday's selling were the same as they have been for the past few weeks. Investors are worried about a recession because central bankers are taking a hard line against inflation and raising interest rates to cool the economy. All year, stock prices have been all over the place because of changing predictions for inflation, interest rates, and growth. However, the latest wave of selling has pushed major U.S. indexes to new lows for the year. The S&P 500 fell 2.1% on Thursday, which was the biggest drop in a single day in more than 2 weeks. With this loss, the index has dropped in 7 of the last 8 trading days and has dropped more than 6% in that time. After falling by 24% this year, the S&P 500 is now trading at levels that haven't been seen since November 2020. It was clear that investors were nervous in other markets, too, because stocks, government bonds, and oil prices all went down. The British government announced a new tax cut plan last week, which sent bond markets into a tailspin as investors worried about a rise in borrowing. This has caused an economic firestorm in Britain over the past few days, which has added to the chaos on global markets. Government bonds, which were thought to be safe investments, lost a lot of value after that announcement. This made many people worry about how well the financial system could handle the shock. How we cover the world of investing. This year, it's been hard to watch the stock and bond markets go down, and it's still hard to know what will happen next. It's been a bad year for bonds. This is the worst time for bonds since at least 1926, and maybe even since the beginning of time. Some investors don't see how the Federal Reserve can lower inflation without risking high unemployment. The Fed seems to be more upbeat. Getting through the storm, people who are paying for college, retirement, or a new home have been hit hard by the crash of the stock and bond markets. Here are some tips. College savings, 529 plans are falling because the stock and bond markets are unstable. What are parents to do? There is no one answer that works for everyone, but you do have choices. Bond prices have changed a lot in the last week, which is typical for this year's financial markets. This is because rising interest rates have caused sharp changes in the value of government debt. Investors were worried until Wednesday, when the Bank of England stepped in and promised to buy as many British government bonds as it takes. By Thursday, trading in government bonds in both Britain and the US was calmer, but still uneasy, and yields went up as prices went down. In the United States, the yield on a 10-year Treasury note went up to about 3.76%. On Wednesday, for the first time since October 2008, it briefly went over 4%. The return on the 10-year gilt, or bond, in Britain also went up to 4.14%. Even though the chaotic response to Britain's spending plan added to Wall Street's worries, the biggest cause of worry this month and for most of the year has been the threat of inflation, which is rising at the fastest rate it has in 4 decades. Jerome H. Powell, who is in charge of the Federal Reserve, has been very clear that the Fed wants to slow down the economy. This suggests that the Fed is willing to do this even if it means putting the country into a recession. Fed officials are hopeful that they will be able to bring inflation down to their target rate of 2% without causing a recession, but investors and economists are not so sure. Analysts say that the market won't stop worrying until central bankers see that the economy is slowing down, which could make the Fed stop raising interest rates. That's about the only thing that will slow down the Fed, said Victoria Green, Chief Investment Officer at G Squared Private Wealth. Even though overall measures of economic activity in the U.S. show that growth has been slow this year, there aren't many signs that the job market is slowing down a lot. A survey by Bloomberg showed that economists expect the government to say on October 7 that employer added about 250,000 jobs in September and that the unemployment rate stayed the same at 3.7%. In the coming days, investors will get more news about the economy, such as more data on inflation in Europe and the US on Friday. On Thursday, Germany said that its consumer prices rose at an annual rate of 10.9%. This was because the cost of energy and food went up so much. The Pan-European Stocks 600 index went down by 1.7%, and the FTSE 100 in London went down by 1.8%. Tokyo's Nikkei 225 rose 0.95%, and Hong Kong's Hang Seng fell 0.49%. The price of a barrel of West Texas Intermediate crude oil went down by 92 cents and ended up at $81.23. With that, our video ends here. Please subscribe to our channel for latest updates about the finance market. I will see you in the next video.